There's a lot of ways for you to use cryptocurrencies to make money for yourself without being a trader. One of my favorite ways is liquidity pool farming. And in this video, I'm going to show you how to use this concept and this strategy to see up to 100% annual returns at times. And do so in a way that, kind of manages your risk and gets you there safely. My name is Luis, and let's get back to the drawing board. So the first thing you need to know about liquidity pools are that they are part of what we call DEXs, or decentralized exchanges. If you've ever used something like Uniswap or SushiSwap or PancakeSwap or Aerodrome, Velodrome, etc., these are examples of decentralized exchanges where any user, any trader, like you or me, could go and just swap the crypto that they have for someone else's crypto or some other crypto. These DEXs charge a fee, right? Somewhere between 0.0 something percent to 0.1%. They're relatively cheap in most cases. And the nice thing is that they are basically like a public good. They are built and run and maintained by the community, kind of working together. So I'm going to draw that out so you can get a sense of how that looks. Every DEX is basically made up of many different LPs, or liquidity pools. And these liquidity pools are basically just pairs of cryptocurrencies. So the most common one is usually ETH and USDC, because this is kind of basically the underpinning of many DEXs all over regardless of which blockchain it is. It's usually ETH and USDC is kind of the most popular pair, or at least one of the most popular pairs. Another LP might be BTC ETH, right? And this would allow you to trade between Bitcoin and Ethereum. So you notice that all of these different LPs, they only have two cryptos, but you can actually kind of route between them. So for example, if I wanted to trade, if I had USDC and I wanted to buy Bitcoin with it, I could actually hop from one pool to another. My USDC would go here, and then it would turn into ETH, right? And then from that ETH, it would get turned into BTC. So these kind of pools can work together to kind of dynamically route your trading request from one to the other. This all happens invisibly. So from the user's perspective, all you're saying is, I have USDC and I want to turn it into Bitcoin at the prevailing rate. And that's it. The DEX kind of figures that all out kind of automatically, which is kind of awesome. So how do DEXs kind of survive? Well, a couple of things. They have trading fees, right? And this is actually where your earnings come from, because those trading fees are paid to the people whose money is sitting in those liquidity pools. That means that these liquidity pools are actually they're literally bunches of money, of capital, that have been put in by other members of the community. And this is the part that I'm going to be teaching today. You, as a quote-unquote investor or a liquidity pool farmer, which is kind of how I like to describe it, you contribute your capital, and then you earn from these trading fees. All of you that have contributed capital will earn from those trading fees, and it's all kind of shared. It's like a shared revenue across the entire DEX. All of these different LPs will make a certain amount of money. And as you can probably imagine, the amount of money that you earn has it is dependent on how much trading volume there actually is, meaning how many people are actually transacting on, like, say, ETH to USDC, or maybe how many people are trading BTC to ETH. Depending on how much volume there is, you might make a lot of money, or if it's a less popular cryptocurrency, like maybe something really exotic or something very young that no one has ever heard of, then maybe you won't make as much, right? So typically, it follows the rules of popularity or trading action more than the price itself, because you could make money even if the price of Bitcoin or Ethereum happened to be going down or was down that week, because possibly there are a lot of people buying it because the price is down, right? So you make money on the fees. It doesn't matter to you so much what the actual price of the assets are at that moment. Now, I should couch the rest of what I'm about to say by saying that it is a slight oversimplification, because I'm going to try to go through this kind of in a very basic and fundamental way so you can kind of grasp the mechanism of how these liquidity pools actually work. So you can better understand the risks of what actually happens when your money is in a liquidity pool, so you can understand like what your earnings might actually look like over time. On average, if you are looking at the ETH USDC pool or some other very popular pool, you'll see numbers that are kind of like, they look kind of crazy, right? They'll promise 100% plus APR, annual percentage return, meaning that, you know, theoretically, if you put in a certain amount of money, $10,000, by the end of 12 months of doing this, you would have $20,000 in total. And that sounds great. In fact, there are not a lot of places that you could do that in the traditional world, especially if all you have to do is dump some money into a pool and then just kind of wait for your money to grow. That sounds like an amazing deal. Now, of course, because this is crypto, there are caveats all over the place. And in order for you to understand the risks and the caveats, I have to kind of explain the mechanism of how LPs work, like under the hood. Okay? So I am going to start with a very basic example, and it will be describing the ETH USDC pool specifically. And for the purposes of this example, we are going to pretend that the price of ETH right now is $2,000. I know it's not, but you know, I can dream. And let's say that you had you didn't have so much money, right? So let's say you're working with like under $5,000. The rule of a liquidity pool is that you must deposit funds of equal amounts for the two cryptos that you are about to support, right? So in the case of ETH and USDC, you have to have equal amounts of ETH and USDC. So what do I mean by equal amounts? Well, remember that the price in our scenario is $2,000. That means that if you had 1 ETH to deposit, you must also have 2,000 USDC to go with it, right? Because again, the price of 1 ETH is $2,000. And together, these form your first deposit, equivalent to $4,000 in total at that moment in time, right? Because obviously the price of ETH changes on a minute-by-minute basis, but at least if you took this snapshot, it's worth $4,000. Okay, what actually happens with your money once it has been deposited into the liquidity pool? Well, in order to get to that step, I need to explain one other thing. You need two things when you are depositing in a liquidity pool. The first is you need some money to deposit, of course. The second thing that you need is you need to define your price range. And what that means is that you need to define the range of price where your your deposit will actually be active and utilized. And the reason for that is because it makes it more optimized. It means that our money gets used more. So don't worry if that doesn't completely make sense right now. I'll get into it in a little bit more detail. But for now, let us pretend that the price range that we pick is $1,500 to $2,500. So again, let's just talk about what that implies, right? So what we are actually saying here is that we assume that the ETH price over the next couple of weeks maybe will move between 1,500 to 2,500. And we would probably have made that guess by looking at the previous historical charts. We would look at the last 2 months, for example, and say, well, I mean, I saw a top that was somewhere in the 2,500 range, and I saw a bottom that was above 1,500, so I assume that we're not going to break either that ceiling or that floor. And this is the only part of the entire conversation where we will kind of have to put on our traders' hats. And honestly, this is such a large range. You could have probably tightened this up further if you wanted, but for now, we'll use this as our example because it's easier to illustrate, and plus I can remember the math on this one. So, okay, now that you have your price range and you have your deposit, what happens, right? So you define those two things, you dump your money into the liquidity pool. What does the smart contract, the automatic the automated market maker. What does it actually do with your funds? I'm going to draw this out for you guys as a price scale. And at the top of the price scale is 2,500 because that was the max that we talked about. And then at the bottom of this price scale is 1,500 because that was the bottom that we talked about. And at the middle is $2,000 because that is the current price. Remember, this is kind of our example scenario. Your money gets dumped into the ETH USDC liquidity pool, and then it gets distributed in equal increments across the price range, kind of like buy orders. So what happens? So your ETH is up here. It gets distributed up here, ETH, etc., until it gets filled up all the way to the top, right? And then down here, below the current price, in equal increments also, is USDC. So U, and so on and so forth, all the way down to the bottom. Okay, so that is our x-axis. So this is price. Sorry, that's our y-axis. Our x-axis is time, or how many days, right? Days. Let me go. All right. The reason why we're doing price over time is because we need to kind of see what happens as the price changes, because this is kind of the most interesting part of liquidity pool dynamics. Of course, the price of Ethereum will not just stay $2,000. It will move. It will move every minute. But what we care about really is it moving outside of 2,500 and 1,500? Hopefully not, right? And hopefully it won't do that for the next several days. Now, one of the other key areas of our example was that we were saying that in most cases, these kind of popular pools will usually have 100% APR or more. I'm going to use 100% as my target APR just for the purposes of this example. Remember that we had $4,000 as our USD equivalent total. That means that if you are looking at 100% APR and you had $4,000 in total, you stand to make $12 a day, right? And this is why the time scale matters, because for every day that you stay within our magic range, you make $12, right? That's roughly what you're making on every single day that you stay within this range. Now, if the price actually goes beyond the range, like maybe it's higher, so 2,600, it actually doesn't earn anymore. So you stop earning at that point, and your money becomes dormant. Your deposit doesn't earn. So you kind of want to guess a price range that is kind of reasonable, but at the same time allows your money to keep getting utilized as much as possible, okay? So what actually happens when the price changes, right? So let's say the price, as always, as most cryptocurrencies, right? The price will go like this. If you're lucky, it will go like this, just kind of within the range of what you define, right? It'll always just be within 1,500 to 2,500. But as the price is going up like this, what is actually happening to your money? So as the price goes up, your ETH becomes USDC. And if it hits, as it keeps going up the ladder, all of those ETH deposits of yours get turned into USDC. That is because you are actually, remember that your money is being traded, right? Your money is being traded to other users. So as the price is going up, your ETH is being sold to other users, and they are giving you USDC in return. And you will see the values of your money. It will no longer be 1 ETH and $2,000. It will actually change dynamically with every passing minute as users buy and sell it. But in general, as long as it's kind of within this range, it will be somewhat close to $4,000. It will be still kind of in that general range, right? However, the exact amounts inside your deposit could be 0.9 ETH, could be 2,200 USDC. It could be shifting all over the place, right? So this is the part that you have to get used to. The only time that your money will go back to exactly 1 ETH and 2,000 USDC is if we actually go back to the price that you initially entered at. So if the price of Ethereum eventually goes back to $2,000, then all of this stuff gets reversed. Your USDC that got traded will actually go back into Ethereum, and you will eventually have roughly about 1 ETH and 2,000 USDC again. Okay, plus whatever trading fees you happen to get, right? So basically, the longer that you stay within this range, the better it is for you because as time goes on, you make more money, right? So that's the idea. I described what happens when the price goes up, right? So your ETH becomes USDC. When the price goes down, your USDC becomes ETH because people are selling USDC and turning it into Ethereum. So obviously the ideal scenario is that the market is kind of somewhat sideways, right? It kind of just sticks to this range kind of harmlessly, and your money just kind of moves in and out from ETH and USDC back and forth, right? So that's the harmless scenario, and you'll just make money, and it'll be easy. It'll be like 12 bucks a day on average, and it'll be great. Now, we need to discuss the two other scenarios that are not as great, right? So the first is, we'll talk about this. What happens when the price goes all the way to 2,500 and beyond, right? So you already heard from earlier that you will not be able to earn any money at that point because your money is no longer in the active range. So that part in and of itself is not harmful. It just means that you stop earning. However, remember that your ETH turns into USDC as the price goes up. By the time we get to this top, this $2,500 price level and beyond, we will actually have 0 Ethereum and 4,200 USDC. It means that your entire stash has converted into 4,200 USDC. You have no ETH left. What happens if the price went down instead? Let's look at the other scenario. Maybe the price went all the way down to $1,500 and maybe it dropped even further and kind of like just crashed right through it, right? Well, in the opposite scenario, remember all of your USDC was turning into ETH, right? It's now all ETH. Well, in that scenario, you would have 2.17 ETH and 0 USDC. Okay, so don't ask me how I know the math. I used a calculator before this video, so these are the numbers that you get if you ran this particular scenario. There are calculators for this, and I can put that in the comments so you can kind of do this stuff for yourself when you're experimenting. But these are the results, right? So at the bottom you have 2.17 ETH, and at the top you have 4,200 USDC. Actually, let's discuss the top one here first, right? So the up scenario. You might look at this and say, well, it's 4,200 USDC. I started with 4,000, so actually I'm up by $200, right? And you're right, you are up by $200. However, let's remember that you started with 1 ETH and 2,000 USDC. Remember that in this scenario, ETH is now worth $2,500. So that means that if you had not put your money into this whole pool, you would have 1 ETH that was worth $2,500 and you would have $2,000. Together, if you had just hodled, you would have $4,500 in total value, right? Whereas in the up scenario, you only have 4,200. Meaning you've actually kind of lost out. There's an opportunity cost to this LP thing. You've lost out about $300, right? Because if you had just hodled, I should say, you would actually have $4,500 in total value at that point in time. And this is where time really matters, because if you're looking at a opportunity cost of $300, and you know that you are making $12 every single day, you can actually calculate how many days it will take before you break even. So how many days does your LP have to be active in order for this opportunity cost to no longer matter to you? So the answer is 25 days. And this is kind of what I was saying earlier, where we're kind of looking for a price range that will look good 2 to 4 weeks from now, because you need at least 25 days to make sure that you are actually going to make money from this, regardless of what the price does, right? At least in the up scenario. Now, there is also the down scenario, and that one is a little bit tougher. So in the down scenario, remember, we end up with 2.17 ETH and no USDC. And remember that we started with 1 ETH. So maybe you're thinking, oh, actually, yeah, 2.17 ETH, that's better, right? I actually ended up with more ETH than I started with. Yes, but remember that ETH in this scenario is only worth $1,500 now. So actually, 2.17 ETH is not worth as much as you would think it's worth. It is, in fact, worth only $3,255. That is a pretty substantial loss, because you remember your original HODL value was $4,000. However, it is incorrect for us to say that you have a loss of $745. That's wrong. That's not what's going on here. Because in the scenario where you just held your funds and you didn't enter into the liquidity pool, your 1 ETH would be worth $1,500 now, right? And then you had 2,000 USDC. So actually, your HODL value, in the HODL scenario, your HODL value would only be $3,500 in total. So these are the two numbers that you compare, right? So in other words, it is about $250 loss. Not as bad as you first thought, but it's still pretty bad, right? So again, we kind of take this number, we compare it to our $12 a day math, and we end up with a number that is basically like 20 to 21 days. This is the number of days that your liquidity pool has to be active in order for you to continue making money and for you to break even, regardless of whether we hit kind of this $1,500 price point. So it sounds a little bit long, right? But the interesting thing about this is that if the price stays within that range, you're basically you're just printing money, right? You're not doing anything. You're just watching the price go up and down between $1,500 to $2,500 over and over again, all day long, all week long, all month long. And you continue to make 12 bucks a day indefinitely. So there are a lot of scenarios where, being a liquidity pool farmer and having a kind of a big range like this is actually very advantageous. It allows you to do something when the market is kind of sideways, meaning, it's neither going way up, it's not rallying, but it's also not dumping very hard. So actually, this is kind of descriptive of what's been happening over the last couple of weeks. As I'm recording this, it's late March in 2025, and the market has been it's been a little bit on the low side, but it also hasn't been making any drastic moves. If ever, it moves between 2 or 3% a day, and it's not that much, right? So this ranging kind of sideways market is perfect for liquidity pool farming because you don't have to do much. You can kind of just watch it make money. Now, these are just the basics, right, of liquidity pool farming. Where should you go to begin? Like, if you wanted to kind of get into this stuff for the first time, where should you go as your first stop? My first recommendation is Aerodrome. Now, Aerodrome is the DEX, the primary DEX of Base, which is a Ethereum layer 2. The reason why I recommend Aerodrome and Base is because Aerodrome, or I should say Base, has way lower gas fees, so you can kind of experiment a little bit without incurring the costs of Ethereum. If you are new at this stuff, you are probably going to be going in and out of liquidity pools a lot because you're probably going to be experimenting. So if you go on Base, it's going to be way cheaper. It'll be like fractions of a cent instead, which is way more friendly if you're starting out. So I would review how the liquidity pools work on Aerodrome. I would go with that first. And I would probably stick with the majors, right? So what do I mean by the majors? Well, I mean like ETH USDC, I guess, is one. I like ETH BTC also. And there's some interesting ones in Aerodrome where they actually allow you to trade between ETH and, say, SUI, which is kind of one of the big up-and-coming tokens. I like these majors because it usually means that it is not as volatile, it is not as risky, and very importantly, if the price goes up or the price goes down, you will end up with two tokens that you like, right? You could be all in Bitcoin at one point or all in Ethereum at another point. In both cases, I think I would be relatively happy. So you kind of have to choose these pools based on your level of confidence and I guess your level of comfort about kind of ending up with just a whole bunch of one or the other, right? So I would never do this with a meme coin, for example. I wouldn't put my money in a liquidity pool that includes Trump, for example, because I don't want to end up with a whole bunch of Trump if the price goes in the wrong direction. I'm kind of boring this way. I tend to stick with these guys, which I think is a perfectly reasonable thing for you to start with if you are going to experiment on this yourself. And that's it. In our next video, we're going to be talking about like the next stage for LP farming and what the tools out there are that will help you kind of refine your strategy even further. Hope you found this quick introduction useful and hopefully entertaining also. I'll catch you guys in the next one. Peace.